Right now, at this exact moment, Iranian naval forces in the Strait of Hormuz are allowing Chinese-bound oil tankers to pass through freely, settling their transactions in Chinese yuan while simultaneously blocking Western-linked shipping that would settle in U.S. dollars. Read that sentence again. The country that closed the most important energy choke point on Earth is using that choke point as a currency sorting mechanism. If your tanker pays in yuan, you pass. If your tanker would settle in dollars, you do not. That is not a trade dispute. That is not a naval standoff. That is the most direct, deliberate physical attack on the U.S. dollar's role in global energy markets that has ever occurred in the 80-year history of the petrodollar system. And it is happening right now today in a waterway 21 miles wide at its narrowest point, through which 20% of the world's oil and a significant portion of global liquefied natural gas normally transits. And the dollar index, the DXY, has fallen below 97 to a 4-year low. Gold has surged past $4,650 per ounce. Global central banks net sold $48 billion in dollar reserves in January alone and net purchased 150 tons of gold, bringing gold's share of central bank reserves to 12.5%, surpassing U.S. Treasuries as the primary reserve asset for the first time in modern history. The dollar's share of global foreign exchange reserves has fallen to 56.9%, the lowest since 1995. And in May, the Federal Reserve will undergo a leadership transition that financial analysts across Wall Street, London, and Tokyo are describing as the most consequential change in American monetary policy since Paul Volcker. And the American public is not ready for what that transition means for the value of every dollar they currently hold. The petrodollar system that protected your purchasing power for 50 years is being dismantled in real time. In 1974, the United States and Saudi Arabia struck an agreement that became the foundation of American financial dominance for half a century. Saudi Arabia would price all of its oil exports in U.S. dollars and recycle its oil revenue surpluses into U.S. Treasury bonds. In exchange, the United States would provide military protection for the Saudi kingdom. That agreement created a self-reinforcing loop. Every country that wanted to buy oil needed dollars. To get dollars, they sold goods and services to Americans, or they bought dollars on the open market, or they held dollars in reserve. The global demand for dollars that this system created allowed the United States to borrow at the lowest rates on Earth, run persistent trade deficits without currency collapse, and finance government spending at a scale that no other country could sustain. The Federal Reserve estimates that between 1999 and 2019, the dollar accounted for 96% of international trade transactions in the Americas, 74% in Asia, and 79% around the rest of the globe. Banks use dollars for approximately 60% of their non-domestic deposits and loans. And in the foreign exchange market, the dollar was on one side of almost 90% of all transactions. That is the system that has protected the purchasing power of the dollar in your wallet for your entire adult life. And that system is now under assault from multiple directions simultaneously. Saudi Arabia chose not to formally renew the petrodollar agreement in June of 2024. BRICS nations announced in January 2026 that they would increase the share of internal trade settled in local currencies from 35% to 50%. ASEAN is building a regional unified payment system to reduce dollar reliance by 2027. The share of local currency settlement in Brazil-China bilateral trade reached 40%, up 10 percentage points from the previous year. And Iran is physically enforcing a two-tier transit system in the Strait of Hormuz that privileges yuan-settled tankers over dollar-settled tankers. The petrodollar system was not destroyed by a single event. It is being disassembled, piece by countries that have concluded that dollar dependence is a strategic vulnerability rather than a strategic advantage. And May 2026 is the month when the American institution that is supposed to defend the dollar's value, the Federal Reserve, will be handed to a new leader whose appointment is based on a commitment to weaken it. And what most Americans do not understand is that the petrodollar system was not just an energy arrangement. It was the single largest subsidy in American economic history. Because every country in the world needed dollars to buy oil, there was constant, global, mandatory demand for the American currency. That demand allowed the United States to borrow more cheaply than any other country on Earth. It allowed the U.S. to run trade deficits year after year without the currency collapse that would have punished any other nation making the same choices. It allowed the Federal Reserve to print trillions of dollars during the 2008 crisis and the pandemic without triggering hyperinflation because the world absorbed those dollars into foreign exchange reserves and oil transactions. That subsidy, which economists estimate was worth hundreds of billions of dollars per year in lower borrowing costs and cheaper imports, did not appear on any budget line item. It was invisible. It was the background radiation of American prosperity. And it is now being dismantled by countries that have decided the strategic vulnerability of dollar dependence is no longer worth the convenience. When Saudi Arabia let the petrodollar agreement lapse in June 2024, the signal was heard by every oil-producing and oil-consuming nation on Earth. When BRICS expanded its membership and announced the 50% local currency target in January 2026, the signal was amplified. When Iran began sorting tanker traffic by settlement currency at the Strait of Hormuz, the signal became a physical reality. The dollar index hit a 4-year low, and the financial establishment is calling the greenback a falling chainsaw. The U.S. dollar index, the DXY, which measures the dollar against a basket of 6 major currencies, including the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc, has fallen below 97 to its lowest level in 4 years. That decline accelerated dramatically in 2025 and into 2026, driven by the combination of Federal Reserve rate cuts, tariff policy uncertainty, the Iran war, and what analysts are now openly calling a crisis of confidence in American economic governance. Robin Brooks, a senior fellow at the Brookings Institution, described the situation by saying that the chaotic back and forth of U.S. policy hurts America more than anyone else. One analyst quoted by Diplomatic Watch described the dollar as a __quote_0___. And Nigel Green, CEO of DeVere Group, one of the world's largest independent financial advisory firms, warned investors that while the dollar's place at the heart of global finance was not in imminent danger, its path ahead looks increasingly volatile. He said a multipolar currency world is becoming more plausible, and that investors already treat the euro, yen, and select emerging market currencies as partial hedges against U.S. policy risk. ING published an analysis titled __quote_1__, noting that even after last year's sell-off, the dollar is still strong by long-term historical standards, which means it could fall significantly further if warranted. They specifically noted that the dollar's 45% rally since 2011 has barely been scratched by the recent decline, suggesting enormous room for additional weakness. And the consensus among banks, strategists, and polls is that the dollar will remain under pressure, with the euro expected to gain against the dollar and many currency desks penciling the DXY in the mid to low 90s on average. But what makes May different from the gradual decline of the past 18 months is the convergence of 3 catalysts that could accelerate the decline from orderly to disorderly: the Fed chair transition, the Hormuz crisis deepening, and the possibility that the new chair's first public statements or first-rate decision trigger a confidence shock that causes foreign investors to reassess their dollar exposure in a compressed time frame. A disorderly dollar decline is not a gentle weakening over quarters. It is a loss of confidence event where the selling feeds on itself because every seller makes the remaining holders more anxious, which produces more selling, which produces more anxiety. That feedback loop is what happened to the British pound in September 2022 when the Truss government's fiscal plan triggered a currency crisis in a matter of days. The United States is not Britain, the dollar is not the pound, but the mechanism is the same, and the conditions for it are assembling in May. The DXY's decline from above 107 in late 2024 to below 97 in April 2026 represents a loss of more than 9% of the dollar's value against major currencies in approximately 18 months. That pace of decline, in a currency that anchors the global financial system, is not gentle. It is the kind of movement that triggers institutional rebalancing, hedge adjustments, and reserve allocation decisions that themselves accelerate the decline. The BIS, the Bank for International Settlements, published research showing that Asian investors in particular had been significantly underhedged on their dollar exposure, meaning they held large dollar positions without currency protection. As the dollar weakened, those investors began hedging, which involved selling dollars or buying hedging instruments, which put additional downward pressure on the dollar. Danish central bank data on pension fund and asset manager currency practices showed a 72% hedge ratio at the end of last year, meaning major institutional investors are now actively protecting themselves against further dollar weakness. When institutional money is hedging against a currency, it creates a negative feedback loop. The hedging weakens the currency. The weakening validates the hedging decision. More institutions hedge, more selling pressure emerges, and the decline becomes self-sustaining until a major countervailing force intervenes. In the 1970s, that countervailing force was Paul Volcker raising rates to 20%. In 2026, the countervailing force would be the new Fed chair. But the new Fed chair is arriving with a mandate to cut rates, not raise them, which means the single institution that could break the dollar's downward spiral is about to be led by someone whose explicit instruction is to accelerate it. Central banks around the world are dumping dollars and buying gold at a pace that has never been seen before. In January 2026, global central banks net sold $48 billion in dollar reserves. That is not a normal rebalancing. That is a coordinated, accelerating exit from dollar holdings that has been building for 4 years. The dollar's share of global foreign exchange reserves has fallen from 71% in 2000 to 56.9% in the third quarter of 2025, according to the IMF's COFR data. That is the lowest level since 1995, 30 years ago. And the decline has accelerated since the United States weaponized the dollar through sanctions against Russia in 2022, freezing approximately $300 billion in Russian central bank reserves held in Western institutions. That single act told every central bank in the world that dollar reserves are not sovereign assets. They are hostage assets that can be frozen by Washington at any time for any reason without warning, and central banks responded by buying gold, over 1,000 tons per year for 3 consecutive years. China's central bank added over 225 tons in 2024 alone and has continued accumulating throughout 2025 and into 2026. Gold's share of central bank reserves has reached 12.5%, surpassing U.S. Treasuries as the primary reserve asset for the first time. Gold has surged past $4,650 per ounce, an approximately 70% increase in 2025 alone, marking its best annual performance in decades. And the gold price is not being driven by retail investors or speculators. It is being driven by the sovereign wealth of nations that have concluded that the dollar is no longer a reliable store of value. When central banks buy gold, they are making a multi-decade bet against the currency they are selling. That bet is not speculative. It is institutional. It is strategic, and it is irreversible in any practical time frame because central banks do not buy gold and then flip it in a quarter. They buy it and hold it for generations. The gold that China bought in 2024 will still be in China's reserves in 2054. The dollars that China sold to buy that gold will never return to the dollar system. Each transaction is a permanent structural reduction in global dollar demand, and the pace of those transactions is accelerating into May 2026, precisely as the institution that manages the dollar is about to undergo the most politically compromised leadership change in its history. And the gold price itself tells a story that most Americans are not equipped to read because they do not think of gold as a monetary instrument. They think of it as jewelry or as a speculative commodity. But central banks do not buy gold as jewelry. They buy it as money. Gold is the only monetary asset that carries no counterparty risk. It does not depend on any government's promise to pay. It does not depend on any central bank's policy. It does not depend on any country's creditworthiness. It simply exists, has value, and cannot be frozen, seized, sanctioned, or inflated away by the decisions of a foreign government. When central banks buy gold at record pace for 3 consecutive years, they are making a statement about every other monetary asset in their portfolio. They are saying we do not fully trust the dollar, the euro, the yen, or any other fiat currency to hold its value over the coming decades. And they are acting on that statement by converting paper promises into physical metal at a pace that has overwhelmed the physical gold market and driven prices to levels that would have been considered absurd 5 years ago. $4,650 per ounce. That price is the market-clearing intersection of sovereign institutional demand and limited physical supply. It is not a bubble. It is a re-rating. The world's central banks have collectively decided that gold is worth more relative to dollars than it was a year ago, 2 years ago, 5 years ago, 20 years ago. And every increase in the gold price is, by definition, a decrease in the dollar's perceived value as measured by the institutions that have the deepest understanding of monetary risk on Earth. The gold market is the world's largest, most liquid opinion poll on the dollar's future, and the opinion, as of April 2026, is the most bearish it has been in the dollar's 80-year history as reserve currency. The new Fed chair will arrive in May with a mandate to weaken the dollar and no institutional check strong enough to stop it. Jerome Powell's term as Federal Reserve Chair expires in May 2026. The president has stated publicly and repeatedly that his nominee must immediately lower interest rates. Rate cuts reduce the attractiveness of dollar-denominated assets. When U.S. interest rates fall, foreign investors earn less return on their dollar holdings compared to holdings in other currencies. Capital flows out of dollars and into higher-yielding alternatives. The dollar weakens. That is not a side effect of rate cuts. For the current administration, it is the purpose. A weaker dollar makes American exports cheaper on global markets. It makes foreign goods more expensive for American consumers, which is a form of trade protection that works alongside tariffs, and it reduces the real value of the national debt, which is denominated in dollars. A dollar that buys less means the $37 trillion in national debt costs less in real terms to service and repay. The administration has been described by multiple analysts as tolerating, if not actively encouraging, dollar weakness to advance its trade agenda. Trump publicly dismissed the dollar's weakness on January 27th, stating that the currency is quote, _to, and expressing comfort with its level, at a time when the DXY was hitting multi-year lows. That statement was interpreted by currency markets as a signal that the White House sees dollar weakness as a feature, not a bug. And the new Fed chair, whoever it is, will arrive with an explicit mandate from the president to cut rates aggressively. The DeVere Group analysis stated that in the near to medium term, the administration is likely to exert further weight on the greenback with the appointment of a dovish Fed chair keen to slash rates and create jobs while the inflation mandate takes a back seat. Stephen Moran, already on the board, has dissented from every rate vote in 2025 in favor of more aggressive cuts. Stanford noted that even though Powell may stay on as a governor to maintain institutional independence, the new chair will set the agenda, run the meetings, and frame the public communications. The chair's voice is the Fed's voice, and the Fed's voice, starting in May, will be the voice of a person whose primary qualification for the job is a willingness to do what the president asks. 3 former Fed chairs warned in a joint statement that this is how monetary policy is made in emerging markets with weak institutions, and the dollar market is already pricing in the consequences. The DXY's decline from above 107 in late 2024 to below 97 today is the market's advanced judgment of what a politically captured Federal Reserve means for the currency that central bank is supposed to protect. What a falling dollar actually does to the price of everything you buy in America. Most Americans do not think about the dollar as a product that has a price. They think of the dollar as the unit they use to measure the price of everything else. But the dollar itself has a price, and that price is set by global currency markets every second of every trading day. When the dollar weakens, the price of every imported good rises by the percentage of the dollar's decline, adjusted for hedging and contract timing. The United States imports approximately $3.2 trillion in goods per year. That includes oil, natural gas, automobiles, electronics, pharmaceuticals, clothing, food ingredients, industrial materials, and millions of other products that American consumers and businesses buy every day. A 10% decline in the dollar, roughly what has occurred over the past 18 months, translates into approximately $320 billion in additional import costs that are ultimately absorbed by American consumers and businesses. That is $320 billion of additional costs that do not appear in the federal budget, are not debated in Congress, are not voted on by anyone, and are not disclosed to the American public as a consequence of the policies that cause the dollar to weaken. They simply show up as higher prices at the store, at the dealership, at the pharmacy, and on the utility bill. An historical analysis of reserve currency transitions suggests that sustained dollar weakness produces 15 to 25% import price increases within 5 years of the transition beginning. That is not a forecast from a fringe source. That is the range derived from the experience of the British pound's transition from reserve currency status in the mid-20th century, which took 26 years but accelerated dramatically during crisis periods. The pound's share of global reserves fell from 90% in 1947 to 11% by 1973. The transition indicators that preceded the pound's collapse include military overextension requiring deficit spending beyond sustainable levels, trade account deterioration, and the emergence of alternative reserve currencies that offered superior stability. Every one of those indicators is present in the United States today. Military spending is at record levels and climbing due to the Iran war. The trade deficit is persistent and structural. And alternative currencies and assets, including gold, the euro, the yuan, and digital payment systems, are being actively developed and deployed by countries that represent the majority of the world's population and a growing share of its economic output. And the import price impact falls hardest on the Americans who can least afford it. When the dollar weakens 10%, the price of imported pharmaceutical ingredients rises. The price of imported food products rises. The price of imported clothing rises. The price of imported consumer electronics rises. The price of imported automobiles and auto parts rises. America's domestic manufacturing capacity does not exist at a scale that can substitute for these imports in any meaningful time frame. The supply chains were offshored over 40 years. They cannot be reshored in 40 months, which means the import price increases caused by dollar weakness are not optional. They are not avoidable. They cannot be budgeted around by switching to domestic alternatives because the domestic alternatives do not exist at scale. The dollar's decline is a tax on every American consumer that appears in every store, every pharmacy, every dealership, and every online shopping cart, and that no politician voted for, no agency administers, and no government program offsets. It is the most regressive tax in the American economy because it takes the same percentage from a family earning $40,000 as from a family earning $400,000. And for the family earning $40,000, that percentage is the difference between making rent and not making rent, between filling the prescription and skipping it, between feeding the children dinner and telling them there is nothing tonight. The Strait of Hormuz has become the world's first currency checkpoint, and nobody in Washington is talking about what that means. The most strategically devastating development of the Iran war is not the oil price spike. It is not the inflation. It is not the military cost. It is what Iran has done to the relationship between energy and currency at the Strait of Hormuz. Iran has imposed what analysts are calling a selective interdiction strategy. Chinese-bound tankers move freely through the strait, settling transactions in yuan. Western-linked shipping that would settle in dollars is blocked. That is a physical military enforcement of a currency preference at the most critical choke point in the global energy system. For 50 years, the petrodollar system guaranteed that oil would be priced and settled in dollars regardless of who was buying or selling. That guarantee was never challenged at a physical level until February 28, 2026. Iran's selective interdiction does not just disrupt oil flows. It demonstrates in real time to every oil-producing and oil-consuming country on Earth that the dollar's role in energy markets can be bypassed, that a major oil transit route can be operated on a non-dollar basis, that the physical infrastructure of global energy trade is not inherently tied to the dollar. It is tied to whoever controls the waterway. And Iran, by charging tolls of over $1 million per ship and by selectively allowing yuan-settled tankers to pass, has created a working prototype of a post-dollar energy transit system. Every country that watched this happen is now recalculating. Every central bank is asking if the Strait of Hormuz can operate in yuan, can the Strait of Malacca, can the Suez Canal, can the Panama Canal? The answer to each of those questions is yes, if the country controlling the waterway decides to impose currency conditions on transit, and the precedent has been set by Iran. In April 2026, while the American public was focused on the ceasefire headlines and the gasoline price, and Iran is reportedly finalizing a joint maritime protocol with Oman to institutionalize coordinated management of tanker traffic through the strait, which could embed Iranian authority over the waterway into a standing bilateral agreement that outlasts the current war. That is not a temporary wartime measure. That is infrastructure. Currency infrastructure, built on top of energy infrastructure, designed to permanently reduce the dollar's role in the most important commodity market on Earth. And it is being built right now while the headlines focus on the ceasefire that already collapsed and the diplomatic talks that already failed. The dollar damage from the Strait of Hormuz will outlast every other consequence of the Iran war, because every other consequence is cyclical. The oil price will eventually normalize. The inflation will eventually moderate. The military costs will eventually wind down. But the precedent, the demonstrated proof of concept that a major energy choke point can operate on a non-dollar basis, is permanent. It cannot be unlearned. It cannot be undemonstrated, and it will be copied. And the timing of this structural dollar damage is converging with the May Fed transition in a way that amplifies both. The new Fed chair arriving with a mandate to cut rates will be managing a dollar that is already weakened by the Hormuz currency precedent. The central bank gold accumulation, the BRICS local currency expansion, the DXY four-year low, and the $48 billion in net dollar reserve sales in January alone. Rate cuts from that starting position do not gently ease the dollar lower. They push it off a ledge that has already been eroded by forces that have nothing to do with Federal Reserve policy and that no Federal Reserve policy can reverse. The Fed can raise rates to defend the dollar's value, but that would crash the housing market, freeze business investment, and deepen the economic slowdown that is already underway. Or the Fed can cut rates as the president demands, which accelerates the dollar's decline, increases import prices, worsens inflation, and further incentivizes foreign central banks to dump dollar reserves in favor of gold and local currencies. There is no path in May that protects the dollar without sacrificing the economy, and no path that supports the economy without sacrificing the dollar. And that is the trap. That is what the convergence of geopolitical, monetary, and structural forces has created in the space of 8 weeks. A trap with no exit that preserves both the value of the currency and the growth of the economy. Every American who holds dollars, which is every American, is inside that trap. And the door closes in May when the new chair walks into the Eccles building and makes the first decision that will determine which side of the trap the American economy falls toward. The purchasing power of every dollar in your savings account, your checking account, your retirement fund, your paycheck, your Social Security check, and your wallet is on the line. Not in the abstract, not in theory, in the specific, measurable daily exchange rate between the dollar and every other currency and commodity on Earth. And that exchange rate is moving against you right now, today, and it will move further against you in May. And virtually nobody on mainstream financial television is connecting these forces into a single narrative and telling you what they mean for the cash in your pocket and the savings you spent your entire career accumulating. The dollar is not just weakening. The system that held it up for 80 years is being restructured around it, under it, and without its permission. And May is the month when the last institutional defender of that system changes hands, and the person taking over has been chosen not for their independence, but for their compliance, not for their commitment to the dollar's stability, but for their willingness to cut rates on command. The 80-year monetary architecture of the Western world is being handed to a political appointee in the middle of the most severe challenge to dollar dominance since Bretton Woods. And the American public, whose savings, wages, retirements, and purchasing power are denominated in the currency that is under assault from every direction, has not been told what May means in language that connects the geopolitical, monetary, and institutional forces into a single comprehensible picture. Until this video.